All right. Well, people are still streaming in, but I'll start and get us through the boring stuff so we can move to the discussion quickly and make the most of the next hour and a half. Thank you everyone for coming. My name is Jack Gross. I edit Phenomenal World, publication of the Jane Family Institute. We focus on political economy and critical social science. I'm extremely excited to be introducing this event today. We have a really incredible lineup to talk about a few very simple and manageable topics, commodities, geopolitics, and climate. The panel is called The Geopolitics of Stuff, inspired by a piece by the excellent journalist Lee Harris in the American Prospect called The Vibe Shift to Stuff. And it was put together by Tim Sahay and Kate Mackenzie. Tim and Kate have been working on a new project to cover the climate, everything climate nexus, as Kate put it, and I'm really lucky to be working with them to publish it. This event is a bit of a launch for this new project, which is exciting. It's called the Polycrisis, and over the coming weeks, it'll feature a regular newsletter by Kate and Tim, an essay series, and further roundtables like this one. They'll all be published initially through Phenomenal World, and you can sign up for it in our regular newsletter through this link. Oh, that did not hyperlink. 1 second. And click the Polycrisis tab there to get added to the list. Okay, let's move on to the discussion. I'm going to do very quick introductions because no one here really needs one, I think. And we'll start with a brief note of regret, which is that at the last minute, Isabella Weber had to cancel. She's currently in Germany working on a hard deadline at the end of the week on the gas price commission, which is a very timely and reasonable excuse for missing out on our discussion today. So we're wishing Isabella luck in the next few days. Okay, so on to the discussion. Today, we're extremely lucky to have with us Joe Weisenthal, who's at Bloomberg, the co-host of the Odd Lots podcast, Thea Riofrancos, Associate Professor of Political Science at Providence College, Skanda Amarnath, who runs the very excellent think tank Policy Shop Employ America, Tim Sahay, who's a Senior Policy Manager at the Green New Deal Network, and Albert Pinto on Twitter, and Kate Mackenzie, a Bloomberg contributor, who's going to be leading our discussion today. And I'll pass it off to Kate, and everyone will talk for about an hour and a half. If you have questions, you can drop them into the Q&A box, but no promises that we'll get to them because there's a lot of people here and some extremely big questions to tackle. So yeah, everyone enjoy. Thank you again very much for being here. And again, please sign up to follow the Polycrisis over the next couple weeks. Thank you so much. All right, take it away, Kate.
Great, thank you so much, Jack. And yeah, thanks everyone for being here. I'll just provide a tiny bit more context for the project, the Polycrisis project that Tim and I are putting together with amazing support from Jack. Tim and I met via Twitter back in the pre-pandemic days. And because we both came to climate change from other areas, him from physics and academia, me from finance and energy journalism, we had a sort of shared understanding of the climate action imperative, but also a really genuine kind of interest in how that could be integrated into all the other systems that the world operates on. So not just nature and energy systems, but you know, everything else. And obviously, as in the last sort of 2 or 3 years, that's become more and more salient. We found lots of really smart people thinking along the same lines, including those people on our panel today, and a really wonderful launch platform in Jane Family Institute's Phenomenal World, where Jack and Meyer and Snoger and the colleagues have been building this great space for thoughtful exploration on how the world works and how it could work. So I will jump straight in with Joe. I've asked all the panelists, or we've suggested to all the panelists, Tim and I, that they're welcome to also ask each other questions. But because there will be a lot to talk about. But Joe, I'm gonna kick off with you.
Cool.
Yourself and Tracy on the Odd Lots, Tracy Alloway on the Odd Lots podcast have covered so many of these aspects in the last couple of years of the emergence of the real world, the physical world, becoming something that we all kind of have to contend with, and by we, sort of those of us in the sort of privileged global north, I suppose, who haven't had to think about these things in this way for quite a while. And your show's been exploring the emergence of choke points, the bullwhip effects, and all these other kind of bottlenecks and so forth, driven by the rapid shutdowns and reopenings around COVID, and now geopolitical realignment, and to an extent, I think also the increasingly frequent and severe weather events. So what I'm wondering is, having sort of seen and listened to so many smart people on all of these topics. And I remember when you and I were kind of in the early FinTwit macro blogging days of the late 2000s, and it was all about finance and the financial plumbing and sort of getting to grips with that, and that was the key to kind of understanding how the world worked and what was driving everything in a sense, and now we seem to be in this quite different world. So I'm curious about where you see the role of macroeconomic policy now, and do you feel like we're in this really different world where things need to be monitored much more specifically, separately and individually, and if so, how do we do that? Because that's that's been the domain of companies for a long time. So do we need more government intervention, and how does that work? And then I have a kind of related question of how do we kind of keep all of that together, keep the knowledge of all of these different systems together? It's a little angsty for me, just how does one keep on top of all of this?
Thank you so much. Really psyched about being here. And it's true, you mentioned the old days of finance Twitter and 2010, and probably would have been a lot of people talking about bank credit default swap still, and in the post 2008 2009 environment, that was dominant. It was all money stuff. It was all finance. I feel for journalists of that time specifically, it's those who understood sovereign finance, those who understood bank balance sheets, etc. Were in the strongest position. And I think by and large, that was the story for 2010, and the biggest challenge that most certainly rich economies faced in those years, and it was a global issue was insufficient demand, aggregate demand, and the problems, certainly in retrospect, I mean, it seemed challenging at the time, but in retrospect, I think now a lot of people would say oh, we wish we could go back to those problems, because we know how to solve an aggregate demand shortfall. And a lot of people that we talk to are pushing it. It's spend more money, invest more, build infrastructure, all of these things. And there has been this flip, which is what we're talking about. And, in a way, that flip, the last decade, it was all finance to some extent. There's so much about money specifically, it crescendoed arguably in March 2020. And they finally, they did this huge fiscal bill, and the Fed unveiled all of these new tools and backstopped all these markets and stuff. And ever since then is when the story really flipped, and whether it was supply chains, or in this year energy. And of course, our journalistic approach has never been, I don't think we're particularly ahead of the news. It's what are people talking about? And then let's pull on those strings. And so for us, it was December of 2020 was when we did our first episode on, we know, people said they're shipping costs between China and the US are getting really high. What's going on there? That was the first one that was about that. And it wasn't 2021, we spent the whole year talking about supply chains, but it wasn't an intentional thing. It was that's kind of weird. What's going on with shipping costs? And then we discovered, it turns out that, there's all these imports from China into the US, but it's not reversed. And then the ships are going back, but they have nothing on them. And so there's a lack of containers in China because they didn't really ship anything back. The boats turned around, and that caused container prices. And then it's like, okay, well, we got to follow up more on that. So what's going on at the ports? And that's like, okay, ports. Oh, well, there's all these issues with the trucking bottleneck because there's so many shippers coming in. And so the trucks are waiting a long time. And then, over the course of the next few years, then it became supply chains and energy. The thing I think, 2020, again, going into the last decade, it does feel like the problems were a little simple. It's like, yeah, just spend more. Don't hike rates as aggressively, right? Like, let's boot demand. And I think for a lot of thinkers now, things are much more challenging. I don't think there's some grand unified equivalent to solving a problem of global stuff coordination, whether it's logistics or whether it's energy or whether it's how to incorporate renewable energy onto the grid, all of these things that we talk about all the time. One thing I will say, though, that's really important is that the sort of traditional macro world, it still exists. The Fed is still more or less in the traditional macro framework. We can talk all the time about supply chains and the idiosyncrasies of inflation in Europe, et cetera. And there is, at the moment, there's not a ton of appetite for that. It's we spent a lot of in 2021 talking about lumber prices and used car prices. And what happened was there was a housing slowdown in the 2010s, and then all the lumber mills went out of business. And then there's a shortage of lumber capacity and therefore lumber prices. And now we're in this world. It's yeah, no one wants to hear your excuses about why inflation is 10%. Stop talking about it. So I think there's an interesting intersection here where it's there can be this conversation okay, what's really going on? What are the pain points? What are the pressure points when it comes to energy and supply chain? And the fact that there is still just this sort of very conventional, straightforward macro world of people looking at high inflation and saying, okay, you need interest rates to come down. And I think the interesting question, or we got to hike interest rates to fight that. And so I think a lot of the interesting questions that will emerge for us and for a lot of the people that we talk to is where does the pain point come in when you're sort of trying to apply these blunt macro instruments to situations in which the problems aren't blunt, right? The situation with energy prices in Europe is not, everybody knows that the ECB does not have the tools to address that, right? Mm-hmm. Nonetheless, the ECB is what they have, and there's going to, and so the ECB is going to do its thing, and the Fed is going to do its thing. So I think they're just these really interesting questions about okay, well, there is this sort of classical mainstream macro world, and we can identify all these pain points, and what happens when we apply sort of these blunt instruments to a world that's suddenly fragmented and complex and reorganizing and re-architecting itself. To my mind, that tension between those two things is the interesting story right now.
Yeah, and it is. I mean, it's such a hard one, isn't it? In terms of the tools that are available, just don't really seem to be up to the job, or
right,
not fully. Yeah.
I mean, look, it's housing is, most people would agree, there's including everyone at the Fed, is there's a real problem with housing. It's got egregiously unaffordable, rent surged, et cetera. It would be nice if we had a strategic housing reserve, there's a strategic petroleum reserve, and then we could use Skanda's plan of selling off housing now with the commitment to buy more housing in 5 years, but we don't. And so it'd be nice to do that, because what's happening right now is they're raising rates, and it's making mortgages go up, but it's not doing anything supply is going to get much worse because home builders are just all right, we're out of the game now. So that's a clear example of kind of what I'm talking about is okay, the blunt tool is probably going to have some effect by crushing the housing market that will probably help just ameliorate inflation. But the actual core problem was why is housing in the US perpetually so expensive? Why is it financialized? Why is rent going up? Why can't people have a dwelling where they want to? Is one where it's no, at some point there's going to have to be a housing specific policy. Otherwise, we're just going to keep on this roller coaster where no one wants to build because they're worried about the bottom falling out, et cetera. Again, so the SPR, Skanda's SPR idea, it's we need that for all the sectors.
Yeah. Well, speaking, okay, so on that topic, I might throw to you, Skanda, to just take us through what your SPR proposal was, because I think it's such an interesting example of a very specific tool that didn't face political, a way around the kind of political limitations, I guess, in the US, but also something quite different to the sort of blunt tool of monetary policy. So if you want to tell us like how that idea originated and how it kind of played out, because I think it is a great example.
Sure. So the SPR is the Strategic Petroleum Reserve. It's a series of salt caverns that the U.S. government owns, and they have been filled historically with a lot of oil. Not completely full, but they are currently being drawn down upon and providing some marginal contingent supply to the market at a time when it makes sense given all the supply risks that were at play from the Russian invasion of Ukraine, right? So there's all this sort of sanctioning policies, self-sanctioning, attempts to effectively restrict the Russian economy, Russian industry. And there's just prices aren't just reflecting sort of supply and demand, but also risks. And as a result of that, we saw prices spike on the onset of this Russian invasion of Ukraine, largely because there's a risk of like precipitous declines in global supply, right? And ultimately, global supply and global demand kind of dictate kind of where prices go. I mean, that's probably simplistic to some people, but it's a pretty good approximation for commodities, at least in particular. So, like, what do you do about that when you have actually precipitous decline, like risk of precipitous decline in supply? There are sources of supply that really matter for the oil market, but to make those actually accelerate, how can you do that more effectively? Oil prices were already high, kind of relatively high given the recent history because of even before the invasion itself. And one of the drivers of that was U.S. underinvestment. It's a U.S. Has grown as an oil producer. It's been a much more dominant oil producer now and produces more in Saudi Arabia. That has been a function of the fracking revolution in the 2010s. And so the U.S. was that swing producer, but we had pretty big oil price crashes in a matter of 7 years. We had the big 2014 to 16 decline in prices that went from triple-digit oil prices to 25. We had a bit of a mini crash in 2018-19, that kind of like related to like the trade war, I guess, to some degree. And then we had negative oil prices in April, May 2020. That cyclicality shakes out producers. It forces more producers have to restructure, be bought out, and it has led to a more consolidated industry in the U.S. But it's also led to an industry that's more reluctant to invest. Shareholders are really mad about the amount of lost returns. The losses over the past decade or so in the industry has led a lot of shareholders to be fed up and demand that management sort of commit that their risk mitigation technique should really be one of underinvestment. Better to underproduce and settle for high prices, and you can shut it down when you need to, than to go all in on production growth and prices crash, and then you're left holding the bag, right? So that cyclicality, now obviously this is in the context of, there's a climate component to it we can discuss separately, but in terms of just as an industry that's really cyclical, the volatility has over time led to less investment, higher hurdle rates. And what the real value of the SPR, in our view, was not really about releasing stockpiles of oil can help to meet current demand, meet current consumption desires, I guess, to some degree. And with oil prices above 100, there's also risk of oil prices going much higher if Russian production really does shut in. So that it has some sense to it. What's the real power, though, is in the vacant storage. The empty caverns can be filled. And if you can take supply off the market in a crash, right, which is what happened. We had an oversupplied market in April and May 2020. We had an oversupplied market in 2015 and 16. If you had the SPR buying oil, acquiring oil in those instances, and you can find ways to contractually bind the SPR into that situation. They can either do that through a forward contract. They can sell options such that when the price goes down, that supply is being taken off and put into the caverns in Louisiana and elsewhere in the United States that are government owned. And so that asset is really valuable to provide a pretty significant amount of stability, actually. I think this is the part that people realize, like, you could do this in a way that's contingent, such that, look, when we get to sort of the climate aspects of this, I actually think low oil prices are neither good for fossil fuel consumption that we want if we want to reduce emissions, and low oil prices are actually not very good for industry either. There's a lot of price. So I'm not saying that there's going to be some kumbaya moment, but there is like an alignment of interest if we can actually now, whether alignment actually leads to anything more, I don't know. But I will say oil prices $80 to $100 is probably something that's pretty manageable for most parts of industry in terms of how to sort of get a return on capital. It's probably manageable for end users. Over time, ideally, you don't need as much oil because we'd like to have an energy transition. Oil price is going to 200 because of precipitous declines in supply, in global supply, is a problem, I think, for not just a whole host of end users. And so you want to avoid this precipitous decline in global supply, and to kind of curb that risk, part of what you could be doing is providing more stability through the SPR over the short run. That's the intuition behind it. You're trying to kind of smooth out some of the volatility. You can't do it perfectly, but it can be really helpful because there's a lot of capacity to buy and sell oil through the SPR.
It's interesting because we always, in the climate world, we always talk about like a managed transition as being the best thing. You don't want a disorderly transition. Nobody wants this. It's kind of harmful in the same way that economic recessions are harmful. Energy crises are obviously pretty bad things to have. So yeah, I'm fascinated by that. And something that I'm not sure if everyone's aware of this, but just the size of the SPR capacity in the US is so substantial. It's like several 100 million barrels of oil equivalent, isn't it?
Yeah, 714 million barrels of storage.
Yeah.
It's going down over time now because they're releasing, and also there's some mandated cells. But it's actually a lot of oil. I think people kind of people say, oh, it's a drop in the bucket. It's like global supply demand balances are usually about range from 500 to 1 million barrels per day usually. Like that's kind of the order of magnitude that they're releasing right now. Marginal demand can be shifted by what the SPR does.
Yeah, it's incredible, really. And look, I guess it's sort of fascinating that this tool exists and it hadn't really been thought of that way. I mean, to my knowledge, and I guess it hadn't been kind of considered before or really explored that it could be applied in this, far more strategic and sort of potentially helpful way. And, I think it's just, it's fortunate that it exists for crude oil in the US. I know other countries have SPRs as well, but I suspect not quite to the scale and not with the same level of agency that the US has. There are many other commodities, of course, that are essential that where these sorts of tools and facilities don't exist. And it's also probably good time to note that we've been talking a fair bit about wealthy countries, global north countries. So it's a good moment to introduce Thea, who is a really exciting, I think, researcher on transition minerals and the sort of political economy of transition minerals, particularly in relation to the global south. So there's so much interest in transition minerals and everything from the more sort of like classical rare earths like cobalt and lithium to more bulk ones like copper. It just seems to be something that sort of fascinates people, largely due to the energy transition, of course, and that some of these materials are only sourced from a really small number of countries. So I'm wondering if you could talk to us about what the fact that some of these commodities can be found in developing countries and global south countries. What does that mean for those countries? Does that potentially provide a pathway to economic development or economic security for some or for the exporters of those minerals or indeed other global south countries? And relatedly, how does that square with the geopolitical posturing that's happening? We're seeing the US and the EU are, shaping up to treat these minerals and the supply and securing the resources and processing as being strategically important and in a way that it hasn't been done before. you've researched this quite extensively, and I think it's your latest paper is about the security and sustainability trade-off around transition minerals. So I'm wondering if you can just tell us about that.
Yeah, thanks so much for the question. So you've already kind of listed them, Kate, and you've done a lot of reporting on these markets too. So we have a bunch of these extractive sectors that are being labeled as critical minerals, which is kind of a technical term that has to do with their important application and susceptibility to disruption, right? And so we have lithium and cobalt and nickel and rare earths, and a host of others. Some aren't on there, like copper, even though they're important, just because the supply disruption, and actually Odd Lots had a great episode on this, maybe a little bit further out, but will probably also come. And I could imagine copper being moved on to that list. But I want to start with a kind of like very simplistic and counterintuitive claim, which is that, the fact that these markets are now linked to fighting climate change and to the energy transition doesn't mean that very much has changed about how they operate, right? I'll complicate that in a moment, but I think what's most important for thinking about the opportunities for them to be a route to development has to do with how they haven't changed more than how they have. So what do we see when we look at extractive sectors? Some similar things that Skanda already laid out, right? We see a lot of boom and bust volatilities. We know why that is. There are inelasticities on the supply end and the demand end, right? So that leads to really swinging prices. Some of those prices are even more volatile because of financialization and commodity trading, right? So we've seen recently with nickel, there's been a bit of a scandal about that. Also, copper price movements are very linked to big movements in commodity trading. Less the case with lithium, we can get into that later, but they're very volatile markets, right? So there may or may not be like the basis for like kind of sustainable, equitable development just for the price reason alone. Your revenues are therefore going to also be very volatile. There are also places where we see these really glaring inequalities and sort of crude power dynamics in the global order. So just a couple of points here. One is there's a huge disparity between where raw materials come from and where the profit eventually ends up and is sort of soaked up, right? I just learned this statistic recently and it kind of shocked me that the top 20% of the global population consumes the vast majority of industrial metals, right? So like there's an extreme inequality in like the distribution of metals and the products that they end up in. That's even more unequal than other sectors. Then like on the sort of ecological end, of course, you have these sectors being linked to a lot of water consumption, particularly concerning vis-a-vis drought and climate change, a lot of toxic waste, and just in general, like lower and middle income countries, despite all the changes to like the global political economy over the past several hundred years, remain like net exporters and net producers of raw materials, and rich countries with China sort of slowly inching its way into this category are like net appropriators. And that's not just resources, that's also the monetary surplus of that trade, right? So it's just like an extremely unequal set of sectors, which is one set of reasons why we might not expect it to be a route to broad-based development within those countries. So I said earlier that I was going to lay out the simplistic story, and I think that that's more or less right. But there's also some changes that are happening now. The problem is those changes don't make it any easier for global South extractive exporters to use those markets as a basis of development. I think that they actually potentially constrain things, though we could debate this a little bit. One of the big changes that we see is that global North countries are moving into these sectors really with a lot of like muscular policy effort, right? There's this whole onshoring trend initially in the US and EU, now also in Canada, which is obviously already a big mineral producer, though not of all the critical minerals yet. So we see countries in the global North kind of saying, we want to onshore these sectors, and we also want to dominate the entire battery supply chain. So what does this mean? First of all, we see like Brussels and DC throwing a huge amount of money across the supply chain. And this is like cheap loans, it's direct venture capital in the case of the EU, it's de-risking, all of these ways that like makes the investment more lucrative and less risky. And just for what it's worth, like no public stakes or equity. Like this is just a giveaway without like any public ownership. So we could critique that just within the global North, not even to do with its global implications. But your question is about like, how does this affect the global South? I guess just like two quick points here. One is like, it definitely strikes me as very hypocritical, which I know is not like an interesting critique because like everyone's a hypocrite, but you know, for many decades, global South countries have tried to varying degrees of success to do resource nationalism and industrial policy developmentalism. And they've been chided for it or punished for it or sanctioned for it, depending on the case, or dissuaded from it by the IMF or WTO. And so we see like global North kind of doing what it's told the global South not to do for a long time. That's one thing. But I think the like more concerning, but also more like speculative thing is I'm just wondering how all of this influx of new money and investment on the extractive end in the global North is going to sort of bring more competition to that space, right? So some of the primary producers may not be the primary producers anymore. That might decrease their leverage and also their market share and therefore their revenues. So that's something. And I think like the last point is, like, will we see this hawkish nationalist trend continue? Like, I think the Inflation Reduction Act is sort of the apotheosis of it so far, but we might get more. So like, will global South producers actually be cut off from some of their markets, either because they're like an entity of foreign concern directly, or they deal with one, or just because like we're prioritizing made in America over everything else, right? So I just like, you know, these markets are changing and the policies are changing, but I don't see that leading to new openings for like extractive fuel development in the global South. That's my pessimistic view for the time being.
Thea, can I just jump in with a question?
Yeah, I was just going to go to you, Tim.
What is the security sustainability trade-off? So there's one picture where you have cheap resources in the global South, in the Africa, Asia, Latin Americas of the world, and Western companies go there, make a deal with the local elites of those countries, get cheap resources. They screw around with environmental safeguards and rules, throw contaminated water, you know, kill whoever they need to kill, and then bring cheap resources to the global North. So why should they not want to do this anymore? I mean, where are the carrots that they are getting from the rich world countries for them to come and onshore?
Right. I feel like the first question is almost, why do global North governments that promoted that regime of neoliberal globalization and dispersed supply chains like not want it anymore, right? I mean, it's easy for me to see why investors and firms would take free or cheap money and start setting up operations in new places. But it's less, initially at least, when I first looked into this, it was less clear to me why Washington, D.C. or Brussels were like not satisfied with this cheap import scheme, and also with the ways in which that offshores and externalizes environmental harm and political contention and all of these things, right? So what's kind of interesting, and this loops back to something I was actually gonna ask Joe, so maybe we can talk about it now, which is some of this is like the other side of the aftershock of 2008, or not of 2008, but of the commodity boom that was going on at the same time, right? So like on Odd Lots, Tracy and Joe have talked a lot about how the legacy of the commodity boom, and what we just talked about, and Skanda also talked about, is this kind of capital discipline thing, right? Like this drying up of money for exploration, production, et cetera, and this prioritization of buybacks, dividends, whatever. What's interesting is that at the same time that that's how investors were reacting to the commodity boom and bust, global North governments were for the first time getting worried, and I've like sort of read the archives on this, about their access to raw materials. So like the origin of the kind of onshoring push dates to this reaction to the commodity boom and bust, and global North governments thinking like, wait a second, we don't have an industrial policy to secure these things. China does. And also there are all these new energy technologies kind of coming on the market, and they're going to have a whole new set of supply chains. So little by little in like 2010, 2012, et cetera, in that era, there's these conversations happening. And then it's just in the past couple of years, like with the pandemic, with everything that's changed with global supply chains, where there's been an opening to apply like and sort of broad salience around supply chains and like, actually, okay, let's do something different. The way that this works out, and I kind of already said this, is like, and you also referred to like a bunch of deal sweeteners for supply chain investments, right? So from lithium mining to cathode cells, EVs, the whole thing, like you will get like money, your consumers will get rebates, like there's a whole kind of industrial policy there. But what's like the trade-off or the tension? And I know, Kate, like you asked this and I didn't really answer it. You know, I think there's two, very simply. One, I've kind of already said, which is that like, it's not clear to me that there's like real public benefit from this particular type of industrial policy. more green technologies will be produced. And we could say that's in everyone's interest, but it's a lot of free money for companies that have been basically paying off their investors for a long time. And like, can we use this moment to actually have a bit more leverage in terms of ownership and stakes and decision-making, and maybe even like the scary word of planning and coordination? Like, are there things that we can do other than throw money at companies, right? That's one thing. And then the second is like, there's this big claim that producing minerals in the global north is more sustainable. And that's a lot of the way this is sold, especially in Europe, right? So the public benefit is we get more responsible, ethical minerals out of this. And that, I mean, I could go on, I'm going to just stop myself. I'll just say that that's not prima facie true. That's not apparent. That's not necessarily true. We see some of those same problems that you listed in other countries, like in extractive sectors in the US, right? And so I think there's just like a big regulatory gap until we can actually say like production is more responsible, quote unquote, at home. I don't know if that answers where you're going. I mean, there's other contradictions that I could get into too, which is that like firms like the free money, but they don't like the sustainability binding enforcements, right? So, you know, this whole paradigm gets kind of applied unevenly, and the focus is really on the deal sweeteners and not so much on the like responsible supply chains.
That's so fascinating what you're saying about these ideas originating in sort of 2010, 2012. And was that, I mean, I guess they didn't get much traction then. And it sounds like it was sort of a combination of foreseeing the energy transition and anxiety about China in the West, and anxiety about supply and the sort of demand and price surges. So yeah, that's really interesting. Is that right? Am I sort of capturing that?
Yeah, you are right.
Summarizing that correctly?
Yeah, basically, like, you know, policymaking is a path-dependent process. It takes a lot of either like internal endogenous change or some exogenous shock. And what we have the combination of both. There was like incremental conversations where like the USGS or the DOE would like put out a report and like some people would read it and get like a new idea. But what really shook things was the pandemic, and then the whole geopolitics around Ukraine and Russia, and the energy crisis, like that provided like this much clearer policy opening for these ideas that had been brewing, I would say, for about a decade. And so then they were ready, right? Like that's the other thing about how policy change happens and why can it feel so quick when really like the lead up is quite long.
Can I just throw in, Thea mentioned, you know, the concern, like I remember 2009, 2010, it was like rare earths China. There was so much anxiety about them. And then like that story, like, I don't know, it kind of went away for a decade. And
that was totally,
I was just remembering.
Yeah,
but that was such a big thing. Like, all these commodities that are crucial to iPhones and weapon systems and everything, they're all controlled by China. And then other people like, they're actually everywhere. It's just they're very environmentally costly to extract.
Well, they were in the US. The US was the main producer.
California has plenty.
Was
so
the dominant
sort of,
producer.
Yeah. But I remember that story, and then it went away for like 10 years, and now it's like raging back. Yeah.
But that was something that like that sort of exacerbated the commodity boom, like fear about high prices and lack of access was the rare earths crisis. But yeah, until China sort of took over, it was the US that was the main producer of rare earths, and that shifted when Mountain Pass shut down. So yeah, it's an interesting story.
I want to go to Skanda about this in a minute, but I want to go to Tim actually just now. And Tim, I know you know, I've always found your thoughts so interesting on this question of agency for global South countries in this context of both, you know, an increasingly harsh climate and this massive energy transition that the world has to undertake. I do, you know, it's hard not to sort of take, for me anyway, not to take some of Thea's research as just painting like and Thea, sorry if I'm reading too much into it that's not there, but, you know, it does paint like a slightly kind of depressing sounding picture to me sometimes of, you know, like global North countries continuing to do, you know, what they've always, you know, what they've so long been able to do, and you know, just sort of come out winners on this, on everything, at everyone else's expense. But Tim, I like your, like, you know, the electrostate and the agency of the global South ideas, and I'm just just would like you to kind of hold forth on that for us for a moment and sort of paint that picture. Is that something that you see happening, and where and how?
Yeah, I mean, I guess framing comment would just be that it's easy to, if you think about the vaccines problem and the masks problem of 2020, 2021, that's kind of the model for the energy crisis right now. And the similarity is basically anytime you have a shortage of something, there's going to be a bidding war over it. And in that bidding war, the countries and people who have the capacity to pay the highest prices will get that in a global commodity market. And we saw that with masks. There's like just a few places that could produce enough masks, and most of those masks ended up being flown out of Asia, being flown out of Vietnam and China and so on, and sent to Europe and the US. Similarly, with the vaccines, there was a shortage of vaccines. There was an effort to sort of collectivize it and pool together some money and vaccines for the developing world, but there was always a shortage. So they were sort of at the back of the queue, and the richer countries that could afford to pay higher prices got the vaccines first. And this literally became a matter of sort of life and death. And you could say that perhaps the energy crisis isn't quite like the pandemic in that it's not a matter of life and death, but if you don't have an AC in the summer and if you don't have heat and gas in the winter, there are people freezing to death and boiling to death. So the question of sort of energy shortages has led to, over the last, as Skanda was saying, it sort of began by 2021. In fact, it sort of began as soon as the vaccine was announced, the successful vaccine was announced in the end of 2020. That's when oil prices, gas prices start to recover. So there's sort of a direct link between the reopening of the economy, demand for energy coming back, and prices starting to come back. So ever since we've had a shortage of energy, from basically 2021 onwards, there's been this global bidding war. And we've had sort of a really wild example of that just in the past few days, where the entire country of Bangladesh just lost power, just blackouts everywhere. They'd been doing rationing before that, but at some point, the limited amounts of gas just meant that there was an entire blackout of the grid. And so why is Bangladesh sort of not getting the gas? And it's really wild because Bangladesh had bought gas in long-term contracts on the global market. And the companies that had, were promised to supply Bangladesh with gas were just like, wait a second, I'm getting 5 times the price if I sell into Europe. So I'm just going to break my contract with Bangladesh, pay them the penalty, and then just go and make 10 times the money in Europe. So you have this direct sort of shortages and blackouts in the global south, and energy and ability to pay and finance it through debt in Europe. So that's sort of part of what developing countries are kind of responding to, is that this entire world order is slanted against them. And they have shortages of money on the one hand, shortages of stuff on the other hand, and broadly speaking, shortages of technology, so that they can, make their own vaccines and make mRNA vaccines, or shortages of technology in getting sort of the cheap green technology that they could use to get sustainable, cheap, secure green energy at home. So the question then becomes like, exactly as you posed it, like, are they without any power, or can they actually exercise some of their own power? And in the case of sort of large developing countries like an Indonesia or an India or a Brazil, they do have power. That power is on the one hand just market power. They could say, listen, Indonesia could say, I've got 300 million people in this country. If you want access to my market, these are the conditions by which you have to satisfy them, and you have to try and transfer technology to us so that we could move up the value ladder ourselves. So that's sort of the kind of power the developing countries are exercising at this moment of uneven markets and sort of the geopolitics of war. And what they've particularly chosen is this tool of non-alignment, which is basically saying we are going to be neutral in the war, in Russia's invasion of Ukraine, and we're just going to choose to be neutral. And this is a choice taken by Mexico, Brazil, India, Indonesia, a host of dozens and dozens of other countries in the global south. And on the one hand, it's just based on fear. It's based on, if we sign up in the war and sanction Russia, we would, in the case of Brazil, not get fertilizers anymore. And if we don't get fertilizers anymore, our entire soy market collapses, and we don't make our entire farming sector implodes, and we can't export all the beef and the soy that Brazil exports. And so they are worried on the one hand about what Russia and China could do to them by withholding certain commodities. And on the other hand, they also, don't really want to piss off the West because they're dependent upon the West for technology and money. So they've just sort of chosen the kind of the no man's land position of neutrality. And the idea of sort of the electro-state is sort of the counterpart of the petro-state, which is countries that are rich in oil and gas and make a lot of money from oil and gas by selling it to the rest of the world, using that money to create a social welfare state by paying the salaries of government employees, by creating a welfare state, the kind that Norway does, which is probably the world's most advanced, socially equal petro-state. So the question is, can countries in the global south that have the kind of critical raw materials that Thea described of cobalt and nickel and copper and so on, use that position to become an electro-state? Can they actually industrialize their way up the value chain by saying, we are not going to, a country like Indonesia is sort of saying, we're not going to be selling you raw, unprocessed nickel. You're going to have to come and set up a battery factory inside Indonesia. So the Chinese companies, CATL, the Volkswagen and Tesla are all coming into Indonesia to set up joint ventures with the Indonesian state-owned mining giants. And under that deal, Indonesia gets to now export batteries. So unlike sort of the colonial picture is countries in the developing south, in the global south, export raw materials and then use their sort of precious hard currency to import finished goods from the West. And the current model of the electrostate is to reverse that by actually taking ownership of your own nickel, producing your own batteries, forcing Chinese companies, German companies, American companies to set up shop inside your country and then churn out the batteries that you can then sell for a pretty penny to the rest of the world.
So it's kind of an industrial vision rather than an extractive or not strictly an extractive one, right? Does that kind of resonate for you, Thea? I'm just curious, your thoughts on this.
Oh, I should just say one thing that Thea's been talking about the lithium triangle and the lithium OPEC in Latin America. And I'm wondering if they're actually copying the Indonesian model, or is this just something that everyone's coming up with at the same time?
Well, I think that it's simultaneous. I think it's simultaneous policy development. It sounds like, and in fact, it sounds like the Indonesian one has made better strides than the Latin American producers have, right? Because there's been this attempt, sort of somewhat weak and vague attempt to set up like a kind of lithium OPEC. OPEC's not really the right word for it, perhaps, but some kind of like policy coordination. And so there have been some meetings of Mexico, Argentina, Chile, Bolivia, and those countries have in common having left or center-left governments and having a lot of lithium. What they don't have in common is like how big their sectors are. So like Chile and Argentina are like actual exporters, Bolivia and Mexico, not so much yet. And that kind of matters. But yeah, their ministers are meeting. I don't foresee like a lithium OPEC developing, just because I think it's not an accident that oil is the only commodity that we got third world coordination around, and that it happened in this really particular conjuncture of the you use the word non-aligned, but like the original non-aligned moment, which was just much more auspicious and much more ambitious. And we could go on about that, but there were ideas for an OPEC of copper. I mean, all of these ideas existed, but only OPEC took off. OPEC was the model for them, but none of them reproduced it. I think what we will see, I'm curious if the Indonesia model happens elsewhere. That's definitely what Bolivia wants to do and has not done yet. I think we definitely could see, and this goes against my prior like pessimistic framing perhaps, is more leverage for governments as the supply crunch deepens, right? Like the less lithium you have on the market, the more any given producer has some leverage with companies in terms of the contract negotiations. We saw during the pink tide and the commodity boom, like really dramatic contract renegotiations that funneled a lot more money to those governments. Then we could ask, like, did that end up leading to like post-extractive development, that's like a much thornier question, but certainly much more money stayed in the country. When there's a bigger pie or like a higher price and more to go around, you know, you can sort of play with firms. But I think like the supply chain upgrading is harder. I'll put it that way. Yeah.
So yeah, it's so interesting. I mean, I also wonder if like one of the potential advantages that some of these countries have, and I don't know, this might just be kind of wishful thinking, is just more propensity and or you know, more willingness and experience to be you know, to exercise control and intervention in these, you know, in these sort of critical sectors. But Skanda, I was wondering if you could apply. It's actually, there's a question from the audience from Melanie Brusler that I'm going to kind of steal from or direct towards you, where she's asking, or she's pointing out the SPR is a good example of attempting to manage largely private investment cycles. What else is or needs to be at play to manage investment cycles that underpin a managed transition? And what does that mean for the emphasis that stranded assets is played in climate discourse? I'll probably, I might leave the last bit that feels like pretty like specific to the climate discourse, and I have views on that, I think. But I'm interested in whether you've seen, you know, other examples of these sorts of tools, or you know, are there other potential intervention points that you can see either in the US or elsewhere, or is there just this kind of one happy coincidence of the SPR? I mean, I know you've had some other proposals.
Yeah.
There.
So I think that there is, I'll be optimistic here. I think there is room to do this in the context of a lot of transition inputs that have the same properties of cyclicality, long lead lag time between the time of like decision to invest versus when you get the payoffs of production. And that drives a lot of cyclicality, inelasticity that Thea brought up earlier. These are why we have cycles in these commodities. Oil is hard to store, right? So it's actually not trivial to be able to store oil over long periods of time. Like there are a host of other cyclical commodities, but it's actually a lot more straightforward to store copper. I'm not saying it's completely easy or it's a foregone conclusion, but storing copper or aluminum or lithium carbonate, or spodumene, I should say. But like there are a lot of different ways we can store things. The easier it is to store it, the easier it is to think about these questions of how do we develop the sort of stability here. And I think there's a lot of people now who are interested in stockpiling, like maybe we should stockpile everything else. But it's like, okay, the horse out of the barn, a lot of this stuff, right? So it's like prices have surged on not just oil, but also on lithium, also on a host of other commodities. What do you do about that is really about saying, can you have create the kind of downside certainty? And in that situation, it's usually about the state underwriting some of that risk. If you can do that, then you actually can create the conditions where maybe hurdle rates can be reduced and you can actually make it more economical. There's obviously a host of other give and take that you want to think about when you're designing these policies, for reasons that Tim and Thea both brought up. But at least like that is part of I think it should be part of the toolkit. We kind of highlighted that there are things that even the US Treasury could be doing if they really wanted to. It'd be a little out of the box. It probably would like draw the ire of more people in terms of political partisanship of how the exchange stabilization fund could be used. But to the extent you can actually underwrite like downside risk, like you actually can cut off downside risk in terms of price risk, which is an important component of a whole host of commodities. That I think extremely valuable. Using that well and using that judiciously is a separate question. I think, but I think it is part of how we should be thinking about like a number of things that kind of tick the same set of boxes that oil ticks, which is obviously we don't want to be using oil over time in the same manner. We'd like that to go down ideally. And at the same time, we're going to want to ramp up the ability to produce a whole host of other commodities that it turns out, and kind of going to what we saw, if the 2000s was the China boom and sort of how it drove so much of global growth, the 2010s was story after story in every single commodity where a lot of producers got shaken out. There was so much capacity within China, and that industrial overcapacity also meant really poor returns, having to deal with low prices for a long period of time. And I'm not just talking about oil, we're talking about copper or aluminum, everything else too. And that is a lesson that's still pretty hardwired and seared into the brains of a lot of people making decisions about investment and things that may not rank particularly high in the value chain, but are pretty important to like both the transition and also the economic development itself of how like countries develop and how they sort of advance. And so I think that's like, I think that should be central. I'm very excited that you guys are launching this because part of the climate conversation really should be about understanding how these commodity markets work and how can they be, where are the areas where there's like public sector leverage, where there's room to actually kind of shape things? Because like you should actually care about these markets and what's going on in them. That whether it's fossil fuels or the alternative inputs that are going to be essential.
Yeah, I agree, and it seems like they're so obscure to almost everyone except the people who are like working right in them, and even then some aspects of it are not kind of apparent to everyone, I think. So it's I think like we are all, and I think a lot of people have been really struck by like how successful your proposal, your SPR proposal in particular has been, Skanda, in getting the White House's ear and galvanizing this willingness to intervene. And I'm wondering if that signals is this like one signal of the end of efficient markets being this kind of dominant ideology? It's a bit of a kind of big picture question. I think I'm interested actually, Joe, in what you think about this. And there's an audience question as well, which I will borrow from that's kind of along the same lines. Is 2022 the triumph of the West, end of history, or the beginning of multipolarity? And she's juxtaposing Richard Hanania and Zoltan Pozar. And I think I did want to get into that that juxtaposition of like the US dollar kind of architecture dominance versus this resurgence of stuff and kind of multipolarity. But to just, I guess, initially to just bring it back to that, are we seeing a real turning point or a move away from some of these ideas that about markets and market efficiency as a way of allocating and managing things that have been so deeply held for so many Western governments in particular, but many others for so long?
Yeah, I mean, it does feel like it, doesn't it? And across what I would say like ideological spectrums, I would say like there's a period of sort of market pessimism or pessimism towards the idea that market mechanisms will solve a lot or most of these problems. And, you see it emerging in different ways. The CHIPS Act had fairly, there's people say, what, the current structure is not great, right? The current structure where it's like, okay, you have some R&D focused centers in the US and most of the advanced mining elsewhere manufacturing and semiconductor, that seems not great. That seems to carry risks. And then obviously with commodities themselves, and obviously as Thea was talking about, like concerns, there's like, this idea of like just going to where like the cheapest commodities are, that seems to carry risks. There seem to be national security risks. And then I think also like the boom and bust cycle and is corrosive. And I think people see that like there are real like long-term costs for like having entities get washed out at a market very unpredictable. In retrospect, it would have been nice to have the SPR as a stabilizing force when oil was -40 or 0 or maybe 10 or $20. Like these are like pretty costly things. And I think like, that is one of the stories that even beyond the commodity story that we've been looking at is like, wow, a lot of people are discovering like the slow growth period of the 2010s was just extremely costly in many respects. You mentioned like the decline of lumber mills or the scarring of housing producers that still remember 2007 and 2008 and how much money they lost and how close they came to death. And so even like 15 years later, we've never like gotten back to that old equilibrium of like producing houses like crazy. Yeah. And so I think like going through these cycles, I think a lot of people, regardless of like their sort of like stated ideological priorities, have become a little bit more like, I would say like pessimistic towards market solutions and more optimistic about the idea that the public sector, whether it's through investment, whether it's through curbing ups and downs, et cetera, can play like a positive role in accelerating industry.
Yeah, that's so interesting. I think again, it's it's kind of very like whiplash inducing, having to kind of switch between talking about countries like the US and then considering, you know, what options there are for lots of other countries in the world. Thea, there's a question. There's actually a couple of questions from the audience, which I think are interesting for you. One's directed to you about the role of substitutability in the lithium OPEC idea, which I think is a really interesting substitutability is a really interesting question or kind of element in the whole transition minerals, rare earth critical minerals discourse, which does seem to, you know, focus so much on scarcity and security of supply. Yeah, I think what the question is getting at is I think they're getting at that. They're saying, does the transformation really change the calculus more fundamentally for commodity economy? And then there's another question, and this may also be interesting for you, Tim. Do global South countries actually have the fiscal capacity to underwrite the downside risk of sharp falls in export commodity prices the way that OPEC, if not, is the OPEC cartel model better, or schemes like the SPR, are they good models in the case of more limited fiscal capacity? I'm not sure if the SPR would how sort of flexible or how sort of expensive or non-expensive that would be, but so yeah, I'll go to you first, Thea, and Tim, I'm interested if you want to chime in on some of that too, and Skanda and Joe, of course.
I think that there are a lot of substitution possibilities, not with lithium though, not lithium particularly. Like you have a lot of different battery chemistries and they get pretty ornate, and there are things you can swap in and out, and there are trade-offs around power density, energy density, range, et cetera. But lithium does not get substituted. Not for the time being. And I also think there's just like going to be a huge sunk cost issue here. Like the auto industry is like a multi-trillion-dollar industry, and it is pouring huge amounts of money into one technology, minus, I don't know, Toyota. Like there's some that are still like betting on the hydrogen thing. And I think hydrogen, I'm not trying to downplay, like hydrogen is useful technology for other applications, but I think for like the passenger vehicle and also like a lot of sort of mass transit, we're going to have a lithium battery story. And where you can substitute around, and definitely I'm in favor. I don't know if this is what the person meant, but we should be substituting recycled feedstock as much as we can for new mining, but I don't think you can get rid of lithium. I think also sometimes there's this idea that there's like a magic substance that has no environmental harm, no geopolitical risk, that is like abundant and cheap, and that like if you just use that instead. But that I think is sort of you know, a kind of techno fix that is not real. Like, you know, raw materials are the substrate for all this production, and that is the source of the environmental harm and the geopolitical, you know. So I think you can't get rid of that. You have to do other things. One thing I want to throw out there that maybe we can talk about later or never talk about, but I like want to throw it out to the other, you know, to Tim and Joe and Skanda, is like, we've been, you know, with lithium, there's this crazy supply crunch right now. So I'll just use this as an example. There are, you know, these are the latest numbers from Benchmark Mineral Intelligence, which is like one of the top forecasters. There's 40 or so lithium mines that exist. That includes like really small mines too. So not all of those are big producers, but there's like 40 or so lithium mines globally. And they say that by 2035, we need almost double that in new mines to serve like projected EV demand primarily, right? So by 2035, we need 79 new mines, or if we can recycle a lot, we'll only need 54 new mines. But it's like, we're talking about a huge factor of growth. We also know, and you know, Joe's talked about this like on the show, that like mines take a decade to come online, right? So if we say we need 79 new mines in 2035, like those 79 mines had to start yesterday. We also know that like protest is on the rise, oftentimes for good reason. So some of those mines never happen, they become too risky, et cetera, et cetera. So we have this very intense supply crunch for lithium, and this is going to affect the price of EVs. It's going to mean that subsidies have to increase to cover that if you want ordinary consumers to buy. Like this has a lot of downstream and knockoff like sort of implications. And like, you know, we've been talking about different ways to manage this stuff crisis. Skanda is talking about like reserves and smoothing volatilities. If Isabella Weber were here, she'd be talking about price controls. Joe has talked about just producing more stuff and like how we can incentivize that, like with the housing idea. And I just want to like insert, and I already like wrote this on Twitter, so I did the preview, like also just thinking about how we use what we have, how we channel things to priority purposes, but also how we think about reducing some forms of demand that are just like too much, like affluent people don't need an e-Hummer. Like, do we just make that illegal? It's a terrible use of lithium. I would be in favor of that law, and I could imagine a populist coalition around it, but just to throw out like the War Production Board, the Atomic Energy Commission, the Texas Railroad Commission, these are all agencies at the state and federal level that in the past said, you can only use this raw material for this thing for now, or for these 5 things. And all of it has to pass through our decision-making board. I mean, we've had central planning basically during World War II, right? So there's precedent for this. And I just wonder if like, in addition to price control and supply provision, do we also think about like shaping demand, or like what gets, you know, what end uses soak up this precious, right now scarce kind of material? Just throwing that out there. No one has to answer it, but I
love it. Yeah, I'm a really big believer in you know, that there hasn't been there just has not been enough attention on demand side measures for stuff. And I think, you know, even in the climate world, energy efficiency and demand management, you know, separate to energy efficiency, you know, the sort of two elements that have been, you know, they're really hard to kind of, it's harder to get traction for them. They're less finance, less straightforward in terms of financing, more straight, you know, the returns are a no-brainer, and yet it's really complicated. And yeah, from what I've seen of transition mineral projection scenarios, that's, you know, this is critical, these assumptions about how much is actually used, how much is recycled, and so forth. So yeah, like I really applaud you bringing that up, and yeah, I'm interested if anyone else has thoughts on that. But Tim, I think I was going to jump to you because there are a couple of things in that question.
I just wanted to respond
to
Thea's on this. I mean, just sort of like, of course, there are lots and lots of things you can do. So we can invest in them, but we can also just ban certain types of activities. And she's absolutely right that during a wartime state is when there's scarce materials and you really have to choose, is this rubber going to go towards tanks, or is this rubber going to go towards car tires, right? And that's the sort of decisions that get made in extreme rationing sort of scenarios. But I should also just say, like, taxes are also climate politics. Like, taxes are a great technology to cut climate emissions. I mean, it's just like we could relabel that, but you know, taxes and fiscal policy in general is just like a good way to support certain types of activities and consumption and not other types of activities. So, you know, if you could have like an infinity tax on your 5th home, you know, that reduces the amount of emissions that might be coming out from heating your 5th home through the winter and so on. So you can easily imagine sort of gradated taxes on, I don't know, private jets, on, you know, a tiered tax on long distance flying. You could only do 2 of them a year. Anything above that, you pay much higher carbon taxes that are currently extremely low and subsidizing aviation fuel and so on and so on. So that's an completely underused area of fiscal policy for obvious reasons. Rich people control the levers of political power and therefore can fight back against taxes. And this was exactly sort of the message of the Yellow Vest protests in France, which was, wait a second, you're running around like taxing me for heating oil and for fuel to get back and forth from home and work. On the other hand, you're explicitly exempting private jets and you're explicitly reducing the taxes on wealthy people. That's not fair. So, you know, there's definitely been a huge amount of learning around how unequal these impacts can be and where cuts are demanded and who gets sort of leniency and who gets to bear cuts. And I think that's exactly what we're seeing right now with the energy crisis. And going back to sort of fiscal capacity, there's a reason why, you know, Isabella is unable to join us today, is because she's designing a 200 billion euro program for the German government to subsidize and cap the prices of that people and companies are paying for their energy bills. And if you think about that number, this is 200 billion euros. So that's like 5% of Germany's GDP. Did Germany do that during the 2008 financial crisis? Like the size of the fiscal stimulus in Germany was much smaller than 5%. Was Greece and Italy and Spain and Portugal allowed to do 5% of fiscal stimulus to get through massive unemployment, massive homelessness? No, right? So there's this crisis, like we got to sort of see that in many ways the state is being remade, what the state is allowed to intervene in and at what level and scale it is intervening in is enormous. The British government tried something very similar with the 150 billion euro, 150 billion pound price cap proposal. That's also around 5 to 7% of British GDP. So the scale is really enormous. And as the person asked in the chat, like it's not clear at all if poor and developing countries have the ability to finance that kind of spending with debt. Like India is not going to just go to the bond market and say, by the way, I'm doing a new 5% GDP borrowing, and we are going to use that to invest in solar panels and batteries. Like, or we are going to use that to subsidize people's bills. Like, the Indians would face an enormous amount of punishment by the bond markets if they tried that. So there's definitely sort of an unevenness of what countries are able to do, what they're capable of doing, what are the tools that they're reaching for, and which set of tools they're just like, nope, we're not going to touch that.
It is funny. I mean, I'm a unbiased mainstream media journalist, so I don't take views on what the right policy should be, but I am like totally like bewildered frequently how there was so much appetite for austerity or demand management in 2010, or basically, it's just, it's staggering in retrospect. And Tim, you talk about, was Greece allowed to, or Portugal, were any of them given sort of the green light for fiscal flexibility? Absolutely not. It wasn't even close. It was all, 10%, they had double-digit unemployment across those countries. And it was, the message was austerity. And now it's like they barely touch the idea of anyone, anywhere, whether it's for the rich, whether it's everyone else, the idea of anything about conserving consumption or anything about us is just completely off the table in a way that, like, I find just that rightness or wrongness just really surprising, having witnessed how in vogue that was a decade ago.
It's amazing, isn't it? I haven't read that book, Tim, about austerity that you've mentioned. I did buy it recently, about the how it's evolved. But I remember this too, as well, Joe, and it became. I kind of wondered to what extent it was the Rogoff and Reinhardt sort of narrative, and then the kind of undoing of that. I remember Olivier Blanchard kind of, changed his I don't know if it's changing his mind or but sort of came out more against austerity in 2014, 2015, and it just seemed like that started to kind of. And maybe it was partly because of seeing how bad things became in Greece, but and elsewhere. But it couldn't have been a surprise to anyone, could it? So yeah, it is. It's really interesting. I'm interested too. Also, like there's some of these measures that you were talking about, Tim. Long haul flight, taxes for flights beyond a certain threshold, or I know people like Isabella Kaminska, my old colleague from FT Alphaville, was. I think years ago suggesting these, taxes on private jets. And, it seemed kind of like a ludicrous, before that, it would have seemed like a ludicrous climate person policy or something, but actually it seems to have a bit of popularity. And I imagine, those sorts of measures would not be unpopular in many domestic political constituencies. There's other reasons, of course, why things like that don't tend to get up. But it's interesting to see what the measures are on even on the tax side, and in climate policy, taxes and pricing carbon is seen as this. It's this the kind of the monolithic kind. It's been such a touchstone for everything, and to great detriment, I think, and yet there are sort of so many other more like specific and flexible and targeted ways of doing it. I'm not really sure who that was a big intervention from me as well. But I'm wondering if it might be good to just.
I've got a question
okay.
for Joe. Joe, you've been
Good.
sort of following a bunch of commodities and sectors, everything from oil to wool to batteries. In your podcast, like, is there something new on the horizon? Like, I mean, I don't know. Are we just going to keep finding new shortages and new blockages? Like, what is the new oil and what is the new semiconductors and what's the new masks? Like, are we just going to just find something?
There's all, yeah, I do think we are. I mean, there's all it's, I do think like this sort of whack-a-mole is going to go nonstop. You know, I was actually down in Texas last week, and I was talking to someone, a farmer, and like, due to the drought, hay prices are surging again. And the hay price surge means that people can't afford to carry their cattle for as long. And so there's actually, people are taking their cattle to the slaughterhouses at a younger age. And that means that, okay, that might have some dampening effect on meat prices now, but that means there's going to be fewer, there are fewer like cattle being bred right now due to the high hay cost, due to the drought. And that will mean fewer cattle that are born in a year from now or whenever. So like, it does feel like, and you know, again, the weather impacts is like is a huge part of it. And a lot of what we talk about, what we have been talking about are these sort of big macro things, but all of the drought and climate effects are pretty significant. So it doesn't really feel like that's going away. But I also think, like, I don't know if it's optimistic or pessimistic. That just also seems to be human history, right? I mean, I think that, like, you know, sort of probably could go back 1,000 years and find just like these recurring cycles of like, oh, everything's cheap. We like solved the problem of scarcity, like maybe we thought in 2018 or 2019, and oil is really cheap and coal is really cheap, and we could sort of, the transition is happening, and then reality smacks everyone in the face again. And so I sort of suspect that, like, you know, this is probably going to be the decade of just getting smacked in the face a lot.
I do wonder if, you know, like I've got such a big interest, not just in the energy transition or, you know, the emissions, the energy, agriculture, all these other systems transitions to decarbonisation, but also in the impacts of climate change. And I, you know, obviously kind of when you look into it a lot, it's really hard not to conclude that as much as there's been, you know, volatility periods of you know, despair and bad luck, that we're obviously inexorably going in a direction of a less stable, less benign climate. However, you know, something I was thinking about when I was discussing with Isabella about some of her ideas and some of her comments she's been putting forth recently, is that these impacts, so, you know, just in terms of, you know, what's been happening in what you mentioned in Texas, Joe, and, you know, with Florida just recently, you know, really sad stuff. And Pakistan just, yeah, like, you know, it doesn't really stop. It just goes on and on. But there's something in the fact that, to me, there's something in the fact that these climate impacts are really distributed, really diffuse. And so they don't tend to, you know, you've got like certain communities being really adversely affected at one time, and then others at other times. And, you know, because it doesn't sort of come together, because you don't get this sort of uniform, so, you know, it's not all synchronized. It's harder to kind of create that momentum around resilience and preparedness, and also, you know, cutting emissions to avoid this sort of thing getting better. Whereas with this geopolitical kind of realignment or you know, phase that we're in now, and the pandemic, you know, these things are so big and so hard to, you know, impossible to look away from and ignore, that they're really that they do tend to just change the discourse and change the ideas about what is possible, like, so quickly. I'm interested, I don't know, Skanda or Thea, if that's something that makes sense in terms of, you know, what are the things that tend to galvanize new ways of doing things, new and you know, moving away from old ideologies that might have been limiting in the past, and does it take something like pandemic or a war?
Yeah, I mean, I think that we've discussed already a couple of big breaks in terms of how conventional wisdom has shifted, right? So we've seen, we're talking about even like the hypocrisy of the US, it's generally been very anti, like trying to lecture other developing countries about industrial policy, trade policy, please like stick to this pretty narrow playbook. That's out the window. Now, it's a hypocrisy in one sense. It's also like, yeah, I guess like conventional wisdom and consensus has shifted both within the Republican Party and the Democratic Party, right? If you just take Trump as an example on the right and take Biden on the left now, you've had some movement towards actually there's more room for policy experimentation. There's not going to be the sort of ideological you need to follow, dot your I's and cross your T's according to, let's call it there was a consensus, you want to call it neoliberal, Washington consensus, whatever the term you want to use, but there was clearly a body of ideas that was like used to lecturers for other countries. That has shifted. It's gonna be interesting to see how that sort of the next level of that actually like leads to how collaborative that ends up being with developing countries itself. Like what's like in the end, like there is still a lot of interconnectedness that's not going to go away, in my opinion. And so I think this is still going to be like stuff that's going to still be figured out and evolving, but we've kind of crossed a certain Rubicon there. Likewise with Europe, we've seen the same sort of structure, like a new way of thinking of Germany's no longer talking about fiscal constraints. Like that's just very clearly not the case. And it turned out to be a fiction, but no one wants to admit it that like for Europe, that was not a real constraint. They have real constraints right now in energy. And that's a real problem. So like when the real constraints come up, no one actually wants to talk about like, oh, demand management. We actually should think about what are smart ways to reduce consumption, when it probably would be ideal to think along those lines, however politically unattractive it might be. But there is like a real shortage of things that are really important to standard of living in Europe. And yet there's not really the same kind of attention to that at a time when maybe some type of discipline might be actually helpful. I think there's a lot of room for, you can think of it as, you can see the pessimism in it being a hypocrisy, but I do think it also lends itself to a lot more experimentation if it's done right. It will require thinking about what's the coalition of civil society, those who are probably going to be able to withstand a political cycle, to be able to reshape institutions to deal with these things. I'm not sure. Experimentation can be good and bad, right? Like it can lead to like a lot of failed ideas and just getting a try and it not working. But there is like the upside of the right tail of the distribution is also more possible. So I have some embedded optimism there, which is there are certain dogmas that are no longer with us. That doesn't mean we're going to solve a lot of these problems well, but it does give us a chance on some of these things for developed countries. But also, yeah, there's still a lot to be figured out. So I just want to, we're really, really cautious for a lot of there.
Yeah, absolutely.
One thing I'll just throw in there that, and I'm gonna like shift my focus like to the US away from where I've been intervening more on the global South, which is to say like, I definitely think that something has shifted in the policy conversation. I mean, that's undeniable for sure. What I would like to see, and maybe this type of conversation is one seed of this, is like more actual debate over industrial policy approaches, right? I think like this industrial policy term is very big umbrella, and like almost anything can pass for industrial policy if you call it industrial policy, right? Like, I don't know, is a tax break for a company industrial policy? Like we did that before under neoliberalism. I'm not sure what makes an industrial policy now, unless there's like more of a plan attached to it. But, like, are there things like, I was mentioning before, and it's come up in conversation, like, thinking about forms of like public or social ownership that could play a role. Like, why don't we get something why do we just bear the risk and get none of the profit? Like, are there other ways to do it in terms of that? The demand management and reduction piece, I think, is another missing one. I just think like sector by sector would be interesting to like actually debate what the goals of industrial policy are. Because I actually, and I don't know if I'm the only one here that thinks this or not, but I'm pretty skeptical of bipartisan alignment. Like I tend to think that like bipartisan alignment has happened around terrible things like war and austerity and whatever. And and things that have had bad effects. So like when the parties agree, I'm not like, oh, that's a good thing. I'm like, actually, no, I want more debate. Like what are the Democrats doing that's different than the Republicans? Or like, what's the left of the Democratic Party proposing that's different than the like more centrist wing of it? Like I just feel like we're at a very nascent stage of this in the US. Other countries have, had much more interesting, vibrant debates around industrial policy. But like, I think we should start to distinguish political positions, winners and losers, coalitions, and like tools a bit more, and like maybe just get a bit more granular in our discussion. That's where I'd like to see this. I feel like the conversation shift is not enough. I want to see some like debates and fights happen and like counter positioning around like what tools are better for equity, for, you know, advancing around climate, energy transition, things like that, and not like just lining, you know, corporate profits, you know, whatever, like that sort of thing.
Okay, we're coming up to 90 minutes. Tim, I'll pass it to you for any final thoughts.
I just wanted to say we are starting this new project, Polycrisis, precisely because no one really has these answers. There are too many things moving at the same time. And as this, you know, this phrase policy experimentation literally means we don't know what to do. We're trying to figure it out as we go along. And that seems to be broadly what most countries are trying to actively do, which is why you see one thing and then one thing flips after the another. You know, we're going to ban this and we're going to export it. There's just a lot of flux right now, and partly part of our reason for wanting to launch this project is simply so that we can get together and learn from each other about what the concrete issues are, who are the people sort of blocking something from happening. And all of these things are completely location dependent. I mean, what the US can and cannot do is entirely a function of what the balance of power in Congress is. What Europe can and cannot do is entirely a function of what France and Germany and UK and Italy and the big countries in Europe can agree upon doing. And what an India or a Bangladesh can or cannot do is a function of how many dollars they have, how much fiscal space they have to try out new things. So we basically need to get a bunch of different people with different skill sets and expertise talking to each other, learning from each other, and writing and explaining things to each other, which is why we are launching not just this panel, but a newsletter that Kate and I will be writing and a bunch of essays coming soon. And Jack's posted the link where you can sign up.
Yes, yeah, and hopefully we'll also be hearing more from some of these panelists, or all of the panelists, over the next few months through that project. And thank you all so much for participating. Thank you, Joe from Odd Lots on Bloomberg. Thank you, Thea from Providence College, and thank you, Skanda from Employ America, and thanks Tim, my wonderful collaborator on this project, and Jack and all your colleagues at Jane Family Institute. Phenomenal world. It's really been a pleasure to host this. Okay. Not quite sure how to end it now. I'm just hoping that Jack is going to do it for me.
Okay,
as Tim mentioned, you can sign up there in the corner. There you are, Jack. And thanks, Sanoja, for posting the link in the chat there. If people